So you're 65 years old and you're entertaining this idea of an annuity, but you want to understand what kind of rate of return you can expect from an annuity at your age. Well, that'll be the focus of today's discussion. Hey, I'm Casey Weade, CEO and founder here at Howard Bailey Financial, also a certified financial planner practitioner, and we're here to discuss expected rates of return from annuities. In order for us to do that, we have to first understand a couple of different concepts. And the first thing that we want to focus in on is the types of annuities. What types of annuities are out there? Because today we're going to be focusing in on what's known as kind of an income annuity, essentially. But there's really four different types of annuities. There are fixed annuities that deliver to you a fixed rate of return for a fixed period. There are fixed indexed annuities that tie your rate of return to some type of market index without risk of your principal. You know you're going to lock your gains in periodically. You're going to have upside that's tied to the market, but again, your principal is not at risk. Then you have variable annuities. Variable annuities' primary benefit is delivering to you a tax-deferred shell because the dollars you put into that variable annuity are variable, so they're still at risk. They're still going to be invested in the market, typically in mutual funds or exchange-traded funds. And then you have what people most commonly think of when they think of annuity. You think of an income annuity or something that's been annuitized. So that is when you take a chunk of dollars, deliver them over to an insurance company, and in return, that insurance company gives you an income stream for the rest of your life. No matter how long you live, you know you're always going to have this paycheck come in. So that's often known as an income annuity or annuitized dollars that have been given to an insurance company. But you can also find these types of income vehicles showing up in that fixed indexed annuity or even variable annuity space. And that is due to riders. You can add income riders or guaranteed withdrawal benefits to a fixed indexed annuity or variable annuity where they will always promise to guarantee you an income stream or a paycheck that comes out of that dollar amount each and every year for the rest of your life, whether the dollars are in there or not. The main difference being with a fixed indexed annuity with an income rider or variable annuity with an income rider, you still have dollars that are in that account that can be left behind to your heirs. And then that income annuity, though, those are dollars you've given over to an insurance company, they've delivered to you an income stream, but if something happens to you, there's nothing left for your heirs. And so the biggest thing for us to determine here is how long are you going to live? This decision and calculating the rate of return that you're going to receive is a lot like calculating the effective return you might get on your Social Security, or determining your filing strategy for Social Security is largely dependent on you knowing, well, how long am I going to live? If you're only going to live to 75 years old, then you know that you should probably go ahead and file for Social Security as early as possible. If you know you're going to live to 100 years old, then you should delay that Social Security benefit till age 70. So we have to understand our own life expectancy and unique life expectancy. Often this leads us to using something known as mortality tables. Mortality tables tell us on average this is how long you should expect to live. So a 65-year-old is what we're looking at today, and we're going to be talking about $1 million allocated for this income stream. And for a 65-year-old male, the life expectancy is age 83. For a 65-year-old female, that is age 85. And then you have what's known as a joint life expectancy. A joint life expectancy is taking into consideration a couple that in this instance are both 65 years old. If they're both 65 years old, a joint life expectancy is going to tell us the odds of one of the two of them living to a certain age. And that age for a 65-year-old couple is age 89. So 89 is going to be that joint life expectancy number. Now, what do these things mean? And this is where I think we have to exercise a bit of caution. When we look at life expectancy tables or mortality tables, we look at age 83, we look at age 85 or age 89, that's taking into consideration everyone in the United States. Okay? We know that wealthier individuals have better access to health care, better access to better nutrition. They tend to live longer lives. And so you have to look at this for yourself. You may say, well, I'm already in bad health. My parents have never lived past 75 years old. So I am probably going to pass away prior to my mortality table expectancy age, 83, 85, 89 for that matter. But you also may find yourself at the opposite end of the spectrum saying, I'm in really good health, my parents have lived to 100 years old, my grandmother lived to 104 years old. I think I'm going to live well beyond that age. Because here's the thing, when we look at this number, 65-year-old male, life expectancy of 83, this means that 50% of individuals are going to pass away prior to age 83, 50% are going to live beyond age 83. Most of our families that we work with, they're going to be living well beyond those mortality tables because of those reasons that we just stated. Better access to health care, they take better care of themselves, better access to quality food, and they tend to outlive a lot of these mortality tables. But that's something you have to look at for yourself. Why is this so important? Because we're talking about how long we're going to get that income stream. And in order to understand what that rate of return is, we have to look at something known as the internal rate of return. When you're calculating the rate of return that you're going to be getting from a series of cash flows, income that you're getting from an annuity, we can also look at this much like most people do if they're going to make a major investment in, say, buying a business. You buy a business with that $1 million, and what do you want to know? You want to know how long is it going to take you to recoup your original investment, that $1 million that you put in there. When am I going to get my $1 million back? And then start generating some alpha, start generating a rate of return. What we're saying here, and saying it another way, is I'm going to take this $1 million, I'm going to give it to an insurance company, and they're going to give me a series of cash flows. What if instead I took that $1 million and put it in a different investment vehicle? What type of rate of return would I have had to receive in order to get that same income stream over that same period of time and have nothing left over at the end of this? So let's take a look at a few different examples. We're going to take a look, $1 million, 65 years old. Let's say that they're going to receive an income stream of $45,000 a year. Some call this a cash flow, and this is something I think you have to exercise a little caution with, because you'll hear, well, you're going to get a 4.5% cash flow. You go, 4.5%? That sounds pretty good. I like 4.5%. 4.5% is not a rate of return. That is a cash flow, because we know after 1 year we receive $45,000. Well, if we pass away, there's nothing left. And so what was the effective rate of return? We took a substantial loss on those dollars. And so we know that was a negative effective rate of return, even though we were getting a 4.5% cash flow. The thing that we want to know, just like with Social Security, is where is that break-even point? If we're going to receive $45,000 a year, our break-even point isn't until we're 87 years old, well past a 65-year-old's life expectancy. So if you're going to get $45,000 a year, not break even until age 87, what happens closer to life expectancy at age 85? At age 85, you would have had an effective rate of return of negative 0.5% per year. That means you took that $1 million, you could have invested in a vehicle where you lost 0.5% every single year and still pulled out $45,000 a year and ran out of money at age 85. Now, let's fast forward to age 95. Now, what we're doing is we're getting deeper in that insurance company's pockets. Now we're actually generating a rate of return. So at age 95, we've generated an actual effective rate of return of 2% per year. We live to 105. We're deeper in the insurance company's pockets. That number's getting larger. Now it's 3.5% per year. And we go, that's really not all that attractive, especially in this interest rate environment, getting 3.5% per year. I don't think that makes sense for me. But what if we're able to get $55,000 a year? Does that make more sense? At $55,000 a year, we're going to now break even at age 83 instead of age 87. Well, now we're into the insurance company's pockets much sooner. At age 85, what has been our effective rate of return? If we pass away at age 85, we receive $55,000 a year for the last 20 years, we would have had to generate an annualized rate of return of 1% per year in order to accomplish the same thing. So our rate of return is 1% per year. If we live to 95, the numbers start getting much larger as we start living longer and longer lives. This is why people buy annuity products, because they want to protect against the risk that they live a long life. If you're going to live a short life, it doesn't make sense to have a guaranteed income. So at age 95, your effective rate of return is 4% per year. At 105, it's 4.5% per year. A little bit more competitive, still probably not all that appealing, again, in this interest rate environment. So what if we're able to get more income? We get $65,000 a year. Now our break-even point is going to be age 80. So we break even at age 80 much sooner, and at age 85, our effective rate of return is 3% per year. At age 95, it's 5% per year. And at 105, now we're getting all the way up to 6% per year. And we go, okay, this is starting to look pretty attractive. And we want to live long lives in order for this to make sense. What's happening with the insurance company, I mean, think about this cash flow. At $65,000 a year, we're getting a 6.5% cash flow. And you often hear about the 4% withdrawal rule. Well, we're getting a lot more than that 4%. We're getting 6.5% per year. And how can the insurance company do that when you know individually a 4% withdrawal rate might have a success rate of 90, 95%. And what the insurance company is doing is they're not just looking at your life like you might be looking at your life. They're doing this with a large pool of individuals. They're looking at mortality tables. Half of those individuals will pass away prior. Half are going to live longer. So they're able to take this risk because they're looking at a larger pool. They're looking over a longer time frame as well. Now, what if we're able to get even more income? Now we get all the way up to there to $75,000. We're breaking even at age 78. 75,000 from $1 million, breaking even at 78. It's looking pretty good because at age 85, now we're achieving a rate of return of 4.5%, 95, 6.5%, 105, 7%. And another way that I think is helpful to look at this purchase is an analogy that one of my podcasts gave me on our Retire with Purpose podcast. This guest made an analogy of having a birthday party. So you're having a birthday party for one of your grandkids, one of your children, and you know or you think there should be 20 people coming over to this party. So I'm going to get a cake that has exactly 20 slices in that cake. What if 21 show up? What if 24 show up? What if 30 individuals show up? Now you don't have enough cake. So what you might be willing to do is pay a little bit more to the baker in order to ensure that no matter how many people show up to that party, you're always going to have enough slices to feed everybody. That's essentially why you go down this path of looking at picking up a guaranteed income stream. And I also want to point out, we talked about this spread of $45,000 to $75,000. These are realistic spreads in the type of income that you can expect as a 65-year-old from an annuity. You can expect a spread that could be this wide because each insurance carrier is going to have different rates. They're investing their own dollars in different ways, some much more effectively than others, some are more diversified than others, some have higher ratings than others. And so we want to make sure we're shopping around. Most often what I will see is individuals didn't shop around. They visited with the first advisor that they saw and they said, well, this is the product, this is a guaranteed income that you can get. And they didn't shop around to see if they could get a higher income rate or a higher cash flow rate. You have to be working with an independent advisor if you're going to go down this path so that you can have that advisor ensure that they have access to multiple carriers. They don't just have access that's restricted them to one or two carriers, which you most often see with the really large brokerage firms that are out there today. They have relationships with a handful of firms, so those are the products you get because those are the tools that they have. You want to work with an independent advisor that has the ability to quote all of those different insurance products that are out there so that you have the best chance of getting the highest income possible, but also make sure that they're presenting to you 3 or 4 different income options from different carriers so that you can see why you might choose one over the other and you know that you're getting the best deal possible. In order to have these numbers ran for yourself so that you can determine what type of cash flow you can expect from an annuity, what type of effective rate of return you might be able to get from an annuity, and if this even makes sense as part of your portfolio, all you have to do is call the number on your screen right now to schedule time to visit with one of our financial planners, and we'll run these quotes for you, and you'll be able to see in black and white, does this make sense? We can visit with you virtually or in person, wherever you find yourself in the continental United States.